Good morning and welcome to our update on the Amati UK-listed Smaller Companies Fund. I'm Colin Thompson, one of the sales team at Amati, and presenting today I'm joined by managers Paul Jordan, David Stevenson and Scott McKenzie. The latent value in UK small cap sector is well appreciated by investors, especially in AIM stocks. It's important to note that we look to invest in excellent UK businesses regardless of whether they're on the main market or on AIM. Broadly, 50% of the portfolio is invested in AIM companies, and in the run-up to the budget, there was a real fear that AIM could be adversely affected by the removal of BPR benefits. However, while the tax changes introduced created some challenges, they also present opportunity. So Paul will start off by setting the scene, commenting on the budget and the backdrop for AIM and UK smaller companies in general. Scott and David will then present a review of the fund covering performance, new holdings added to the portfolio, and valuation metrics. And then Paul will conclude with an outlook and summary. Importantly, you have the opportunity to ask the managers questions. So please enter them on the webinar page and we'll cover them following the presentation. With that, I'll hand over to Paul.
Thank you, Colin, and welcome to everybody joining this call. Thanks for joining us. 2024 has turned out to be a pretty tumultuous year in many ways, certainly politically, economically too. There have been many surprises, many twists and turns. Some things that we expected to happen didn't quite happen the way we thought they would. I think in general, markets were predicting a pretty smooth drop in rates, and that's happened really not as quickly or as far in either Europe, UK, US, so major developed markets. So interest rates have been uncomfortably high in the last couple of months, and they've been rising, long-term rates. And politically, it's been a time of very significant upheaval, I think is the best way of putting it. However one sees the election of Trump in the US, we know that it's going to bring major uncertainties, major unexpected happenings next year. I think there's a sense of it's very difficult to predict how this is going to play out, and certain things feel predictable, but we've been here before. That I think next year we're going to be in for a kind of surprise a minute, and that is it lends a sense of, I think, just general discomfort to UK investors. And US investors seem to be much more sanguine about this, and as you'll be very well aware, the US stock market's responded very positively. I think the way I'd maybe the best describe what's going on in the UK is that having been through a pretty severe fall from the peak in 2021 to 23, it feels now like we're in a phase of bumping along the bottom. And in some ways, this is a kind of washing machine phase where we go through green shoots appear. We think things, rates are going to fall, certain cycles are going to turn, and then we get some unexpected twists. Meanwhile, funds flows generally in UK funds have been negative, but on the other hand, and this is very important to remember, stock markets are reflexive and they always respond to events. And in a sense, company managers and fund managers, we're all problem solvers. And when things get thrown at us that are not comfortable, we start busily solving them. And I think it's fair to say that one of the big themes we're going to be talking about a lot today is really robustness. And in the UK, we one of the reasons we've been such fans of the UK small cap over decades is that we have some fantastic companies in the UK, and when they go through times like this, it's clear that there are still winners, and there are still companies that are able to deal with what is quite a difficult situation, and the features that are sort of recurring across the portfolio, things like share buybacks, takeovers. With matching the fund flows as money goes out of funds investing in the market, those are matched pretty much by share buybacks and money coming back in from takeovers. So the market has been shrinking for the last couple of years, and that's a bit of it's a policy problem that really needs addressing. And I think we're at the beginning of that process now of policymakers understanding there's a problem here and beginning to address it. So we had the budget last week, which was a pretty significant event. It unfortunately caused a lot of uncertainty in the lead up to it. That maybe the lead up was really a bit too long, and perhaps there wasn't enough comfort given in in the run up to it over things that were maybe known, or maybe some of these decisions were not really made until the last minute. There was a huge amount of anxiety on AIM, and we're going to talk about this more later. And the anxiety was really focused around inheritance tax relief and whether that was going to be withdrawn from AIM in a kind of cold turkey situation, which is what people were fearing, that it would suddenly just be removed. And that would, of course, would have caused something of a kind of market crisis. That didn't happen. And in fact, something important did happen in the budget, even though the inheritance tax relief was cut on AIM from 100% to 50%. Actually, this was the first time that any policymaker has stood up in relation to inheritance tax and deliberately given the relief to AIM investors. In the past, AIM IHT relief has always been a kind of happy accident that policymakers have kind of gone along with, but nobody's ever come out and said, right, we want this tax relief to be available for the AIM market. So I think for me and for us at Amati, the big positive of that is that this is now an intentional tax relief. And I think really for the first time since I've been talking about AIM IHT tax relief, one can say that this feels like it's here to stay, whereas in the past we always had to say, well, of course, there's the big risk that it's going to go away. So that was a positive development. There's more that needs to be done, and there's in the detail of the legislation, there's a huge potential win, which is not there yet. If the government were to go on and make AIM IHT tax relief available in SIPPs, which would require legislative change, it's not available right now. That would, we think that would actually bring significant amount of new investment into the market and would be hugely positive, and in a way would maybe counteract some of the adverse effects for people who've been planning to use SIPPs for inheritance tax purposes for maybe a decade or longer, have been completely wrong-footed by the change affecting SIPPs in the budget. This would be some way of allowing partial redress for that, but also a much more dynamic and risk-taking deployment of that capital, which would be greatly beneficial for the UK economy. So that's probably, if we had a wish list of things we'd like to see, that's kind of right up there, close to the top of things that we really hope policymakers will pay some attention to. The other thing we started to see is a different kind of discussion of regulatory reform, and I think deregulation is obviously one of the big new agendas in the US, and and this is kind of new, even though it was on Trump's agenda back in 2016. This time round, it feels like there's going to be a much bigger and less defined deregulation drive. We've had nothing like that in the UK for a very long time, and actually stock markets, one of the reasons they've been declining in the UK has really been excessive and very poor regulation, just imposing massive burdens on public companies. And so, the second part of our sort of major wish list for AIM is deregulation. And we think there is now scope for this in a way that there hasn't been for actually a long time. And it feels like the discussion has very firmly moved on in that sense. And we're certainly involved in discussions with the stock exchange and other parties about how that should look. And there's a number of actually fairly easy wins that could be brought in over the next year or two. That would be very positive. I think on the other side of the picture, I'm just going to turn the slide here. This is the picture of fund flows, and disappointingly, UK equity fund flows have continued to be negative, and this is probably the single longest period of negative fund flows that many of us who've been in the market a long time can remember. And it's difficult for the market to make a really significant recovery until these negative fund flows at least stop. At the moment, these are being countered by strong share buyback programs, and a very large number of companies we invest in are doing share buybacks. It's a natural thing to do when your share price is really depressed. It's much easier to buy your own company than it is to buy a company you know less about, and the risks are much less. And it's actually pretty staggering how many companies are involved in share buybacks right now. And of course, takeovers are the other side of it, that they're countering these fund flows. It's always, of course, when you're in moments like this in the market, this kind of bumping along the bottom is how I see it. You can never tell, of course, what the catalyst is for things to change. when change does come, it just feels like a few things conspire for the air to clear. Maybe the relative attractions of the UK become more apparent. There's a lot of foreign investors who invest in the UK. It's one of the big shifts over the last 25 years is UK investors selling the UK market, foreign investors buying it. It doesn't change a lot to change the balance. It doesn't take a lot to change the balance here. And I don't think we're going to get any great big bell ringing when that happens. So, we remain pretty sanguine about the prospects for these companies because, on three conditions really. One is they're very robust companies here. They're exceptionally lowly valued, which of course has been a theme for the last couple of years. We've been talking about this a lot. We'll talk about it again today. And we think that the UK in some ways has the opportunity now to become a bit of a beacon of stability in the world. We often forget the attractions of the UK market amidst all the things that maybe aren't going so quite so well. But we are a major developed economy with pretty sound lawmaking, a good legal framework, still a very effective stock market, even though with deregulation it could get a lot better. And these are the themes we're going to go on to talk about later in the presentation. And with that, I'm going to pass on to my colleague to do a portfolio review.
Thank you, Paul. Yeah, just some scene setting for the fund itself. The fund size at 330 million. Paul alluded to the outflows and the pressures on managers in general, and we've not been immune to that in the fund. And the last 2 years have been quite challenging. Us, along with most small cap funds, have been at the coalface of those pressures, and we have had some outflows, but nevertheless, we retain a very healthy fund today. Our number of holdings at 55 has come down, and I'll come on and explain what we've been doing with regard to that and why we think having greater focus will benefit the fund in the future. And despite those pressures, we have actually improved the liquidity of the fund, and it's quite pleasing to see that our weighted average market capitalisation of the companies that we own is a very healthy 860 million, and that number has indeed gone up quite a bit during these challenging times. So just some scene setting there. We'll come on and explain these features in more detail. Looking at the fund's performance, if you've been listening to our previous presentations, you know that the last few years have been quite challenging for the fund, and we're still not exactly where we wish to be, certainly in the medium-term performance. We can see from the longer-term chart that the fund enjoyed a very strong period up until early 21, and the periods in the market since then have been considerably more challenging for our strategy. But we have been doing quite a lot of work behind the scenes in the past year in particular, refocusing the portfolio and making sure that it's fit for the future and that we can move forward and take advantage of some of the fantastic opportunities that we see in the small cap world. But certainly a great deal of work still to do, some signs of improvement over the past 12 months and in the year to date, but nevertheless, still work to do to get the fund back to where we all want to see the performance numbers being. In terms of what we've been doing within the portfolio, there are two things to highlight here. The chart basically looks at the number of companies within the portfolio, and we've gone back really to the formation of Amati back in 2011, just to give a graphical representation of how the fund has evolved over what is now 13 years under Amati. And we've also looked at the portfolio beta during that same period as well. And looking back a year ago when the markets were very depressed, we came to the view that we needed to participate in market recovery. And we can see from the chart at the top, the portfolio beta has edged up slightly over the past 12 months. The history of the fund has tended to have a beta well below the 1 of the index. It's typically averaged about 0.9, and at the moment we're just below the 1 reading for the main index, which is the Deutsche Numis Small Company Plus AIM. That's our key benchmark here. So portfolio beta has edged upwards, reflecting our more bullish view on future returns. The number of stocks, again, we can see from the history that we've typically had between 50 and 60 companies within the portfolio. Today we have 55. But again, if we look at the more recent past, that number has come down quite considerably over the past 12, 18 months. And really, when we were assessing the fund this time last year, we took the view that we had to really get the focus into the fund. We had a tail of investments which hadn't worked out for various reasons within the fund, and we've really gone through quite a comprehensive exercise of losing some of the underperforming holdings, smaller businesses that weren't serving the fund well, and making sure really that we're fit and healthy for the future. So that process has now taken place. We're now at the number of holdings that we'd wish to be in the 50 to 60 range, and that will be the ongoing range within the portfolio. I mentioned liquidity a moment ago, and it's been a crucially important characteristic, particularly in these more challenging times. As we referred to, we've not been immune to outflows within the funds, and we've had to manage the fund, to cope with that significant headwind. I'm pleased to say that liquidity has improved quite considerably in the fund from where we were a couple of years ago. The weighted average market cap has indeed gone up quite materially, despite the falls we've seen in the markets. And the main thing we've really done is look at the tail of very small businesses that were held in the portfolio previously. And we can see from the chart that companies with a market capitalization of less than 100 million are now less than 3% of the portfolio. And that's been a deliberate outcome that by reducing the number of holdings, that's something we don't feel as though we've been paid to take significant risk at the smaller end of the market any longer. And clearly we have some very big liquidity problems, at the very, very small company end. The core of the portfolio is really the companies above 250 million and up to 2 billion, and almost 80% of the fund is in that category, from 250 million to 2 billion, and that is the absolute core of most of the recent and ongoing stock selection. We're typically not looking at very small companies any longer, given the liquidity constraints that we're seeing within our market. So liquidity, despite the headwinds we've faced, is in a very healthy position for the portfolio as a whole. We've got some very substantial, very profitable companies held within the fund. Paul made reference to AIM in his earlier remarks. That has been, as the slide suggests, a very material headwind for us in particular. Through the history of the fund, we've had a very significant exposure to AIM, and one looks at the past 3 years, it doesn't make for happy reading. The AIM index is down 37% over 3 years, clearly not a satisfactory outcome at all. And that mirrors the fact that the actual UK all-share index is up over the period, so the underperformance from small cap and AIM has been very significant over the 3-year period. The AIM returns are shown in gold on the slide. As I say, those are materially down. Our own index is shown in red, and that's the Deutsche Numis Small Cap Plus AIM index, and that reflects the fund's main benchmark as well. But one can see clearly having exposure to AIM has been a very significant headwind for a strategy such as ours. And just to put that into context, this is a graphic representation of the fund and our exposure to AIM over the past 10 years. And AIM has always been a very important part of Amati's investment philosophy. And we can see here today that we're just over 50% of the listed smaller companies fund is actually held in AIM companies. It has been higher in the past, as the chart suggests. It's been as high as 60% previously. And we can see more recently over the past 3 years that percentage in AIM had indeed gone down to just over 40%. And we have actually taken a strategic view to commit to AIM, and you can see from the very recent trend that we've actually increased the exposure to AIM quite deliberately. So in many ways, the fund is facing the fire of AIM, and we've increased our exposure because that's where we see some very, very exciting opportunities. We're relatively agnostic as to whether a company is listed on AIM or on the main list, and that has been the case for the fund throughout its history, and that will remain the case. We remain absolutely committed to finding great companies, whether they're on AIM or the main list, and we don't see AIM as an obstacle to the future of the fund. If anything, the opportunities are indeed as great as they ever have been in this part of the market. So in terms of what we've been doing with regard to the focusing of the portfolio, I made reference earlier to the fact that the number of holdings have come down. We've dealt with the tail of companies which weren't giving us the returns that we had expected. So what have we been replacing them with? And the chart here just takes us through the key new holdings that have been introduced to the fund in the current year in 2024. As per my previous remarks, we've marked the ones on AIM as small stars. So of the 8 new holdings that we've introduced, 5 of them have been on AIM this year. So we're very much embracing the opportunities in AIM, and we think that's going to be a crucial part of the future returns of the fund, that we find the opportunities wherever they lie within the market. And indeed, some of the companies have actually been raising money on AIM. There has been some fundraisings. What we've not seen are many IPOs, but we have indeed taken part in a couple of placings in AIM. 2 of the companies on the slide here are examples of that. Kitwave is a wholesaler for consumer goods, a business that we've known well for many years. It IPO'd in 2021, a rare success story from that period. And we've held that in our AIM BPR service for clients since the IPO. So a company that we know very well. And it raised £30 million to do a fairly big strategic acquisition. And we supported the company and introduced the stock into the main listed smaller companies fund. Another example of an AIM fundraising was Greatland Gold. Again, a company which is relatively new to the fund, but a business that's well known by our colleagues in our Strategic Metals Fund. So we've again followed it for many, many years. And it managed to raise $325 million in AIM. So a very significant fundraising at what was a troubled time for the markets. And that forms our mining exposure with Hochschild. So we've 2 gold stocks now within the fund, which hopefully give us some excellent hedging qualities within that part of the portfolio. The other stocks are a variety of different companies from different industries, from fund management, Pollen Street, private equity fund manager, a new holding to the fund, which has already performed very strongly for us since we introduced it. And it ranges from other industries such as Jet2. Jet2 is now the largest company quoted on AIM at almost £3 billion of market cap, a company which really has had everything thrown at it over the past 5 years and has come out as a very strong business indeed, fantastic balance sheet and a clear market leader. So really being listed on AIM for us isn't a barrier. Jet2 is a fantastic example of how strong companies can prosper regardless of where they're listed. But in general, we've used this opportunity to refocus the fund, introduce a number of quite exciting new holdings, and we can see from the returns on the far right that so far the majority of those investments have started to deliver positive returns for the fund. So quite a lot of new ideas, a mixture of AIM, a mixture of main list, but very much getting the fund back on the front foot. So with that, I'm going to pass over to David, who will just give us an explanation of where we are today.
This is a slide you should remember from previous presentations. It shows the fund profile under Style Analytics, and it's really been a very, very consistent picture over the longer term. Our style bias is dominated by growth and quality. We haven't drifted from that. It's our long-term stock picking discipline, and if anything, our growth style factors, which is growth in sales, earnings, and dividends, these are now even more above the line relative to the Style Analytics universe. So what makes up that growth bias? This is our own subjective internal classification, but it reiterates the Style Analytics profile. We subdivide our growth stocks into those which are achieving this primarily from organic tailwinds, and distinguish that from those which augment that organic growth with acquisitions, either additive or there may be companies which are seeing ongoing consolidation of fragmented markets, and these are the compounders who have both organic and acquisition growth drivers. You'll see roughly an equal split between those 2 categories of growth. I wouldn't say this is an exact science, but overall, 2/3 of the portfolio we would see as fitting those two growth classifications. Value for us, which is the final category, still does involve growth. But the key thing is that this is likely to be mainly at a lower price point, and the underlying earnings growth is likely to be a bit more cyclical than we see from the other two categories. This next slide is pretty key. This is the money slide. What are we paying overall for that growth bias? And we show here how the portfolio was priced at the last peak of the UK smaller companies market back in late 2021, September 2021. That's the right-hand column. What the valuation of the portfolio looked like a year ago, which is the middle column, and what it looks like today on the left-hand side. So our growth companies have clearly devalued a long way from 2021, and everyone knows that already. It's a function of the environment, the UK smaller companies asset class. But we have revalued a bit year on year, comparing the first and the second column, and that reflects hopefully a turning point in the UK smaller companies market. But overall, we are still in very cheap territory. And that shows that the earnings growth momentum that we've seen from our companies over the last 3 years has not really transmitted into any great re-rating. This is still a cheap growth portfolio by historic standards. One other thing I would highlight here is the last line on this analysis, which shows that average profit margins have moved ahead appreciably since 2021. And this has coincided with what Scott has already been talking about. We have increased the portfolio focus over those 3 years, and in effect we've doubled up on quality growth. So we are invested in some very high profit margin businesses as it stands today. It's not just our assessment of how cheap our portfolio is and how good quality our growth holdings are. Third parties think about the same thing as well. Our takeover slide is becoming increasingly busy and increasingly pyramidal in shape over the last 6 years. We've seen an escalating incoming bid activity from both corporates, a range of corporates, and also private equity. And this is likely to be ongoing under the current market conditions. So it's clear that bid activity is targeting quality growth. And our job has been to go back into the market and replace those fund exits with equivalent types of companies. Scott showed earlier what we've been doing, what we've been adding to the portfolio in that regard, and there has been a notable AIM presence within the mix. It's important to say we're not just looking to replace AIM with AIM on a slavish like-for-like basis. It's just, as Scott has already said, we are finding lots of attractively priced quality growth opportunities on AIM given the current market environment. I would say it's pretty tough out there. Paul sort of indicated that at the beginning. Profit warnings are fairly widely distributed around the market at the moment. And with that in mind, we thought it would be worth highlighting some of our largest holdings on this slide, which we think offer the necessary quality growth robustness going forward. Kinetic, the largest holding in the portfolio. Over the last 5 years, this defence and security specialist has grown revenues at a compound rate of 16% and EBITDA at 14%. And it's achieved that through a combination of organic and acquisitive means. And you would predict it's got pretty good visibility from here to carry that compounding growth going forward, given the current global conflicts And despite that, over 5 years, Kinetic's forward multiple has gone from 17 times to 13 times. So we think Kinetic shares are very good value at the moment. Alpha Group, a name you might not be so familiar with, is a foreign exchange services and investment fund banking specialist. It's another outstanding compound growth generator. Sales have nearly trebled over 5 years, and we feel as investors in the market become more familiar with the name, it can carry on with that growth and re-rate as a consequence. Trainline, a household name, UK household name, which is now making significant progress penetrating ticketing services in Europe. Once again, a mid-teens sales and EBITDA growth compounder over 5 years. The interesting thing with Trainline is it has significant operational leverage from the investment it's made in its already built platform. As it moves into Europe, it adds revenues at the top of the P&L account, and those revenues essentially trickle down to very significant earnings accretion at the bottom, and that through time will pull down the forward multiple and the valuation of Trainline's shares in PE terms. Gamma is a provider of technology-based communication services to corporates, both large and small. Like Trainline, it's been very successful in the UK and is now rolling that into Europe through acquisitions. And we think that should see it continue its 5-year mid-double-digit compound growth. And this is a business that's still only 17 times on a forward multiple basis. Now, each of these 4 companies have rock-solid financial strength, and that's evidenced by the QRR scores on the right-hand column. That's a score that comes from Quest, which is the financial analysis database that we use. It's a measure of financial risk. The higher the number, the lower the financial risk. So you'll see for these 4 companies very high scores, and hence the reason why they are all doing share buybacks. AJ Bell, a name that probably many of you will know, like Trainline, it's a platform business with significant operational leverage as it sees asset growth, and in turn that should drive a similar compounding earnings and falling PE ratio that we hope for from Trainline. Grainger is a UK private residential accommodation specialist, and that's enjoying the strong structural growth in tenant demand and rents due to the undersupply, the shortage of rented housing within the UK market. Renew is a specialist provider of repairs and maintenance services to critical UK infrastructure. It's involved in repairing and maintaining rail, motorway, electricity grid, water, wind turbine, nuclear. It's a very well diversified supplier of services to non-discretionary critical repair and maintenance spend. Like Grainger, it's enjoying significant structural demand for its services, and it has a double-digit compound growth record. And it's making acquisitions in a very fragmented market and is only 15 times. And finally, FRP, which is the corporate insolvency specialist. After years of sub-trend activity in the insolvency market following the 2007-2008 financial crisis and the business support provided during the pandemic, we're now beginning to see administration caseload beginning to rise and return to longer term averages. Once again, FRP is a high teens compound growth story and only valued at 13 times. And again, each of those last 4 companies I've mentioned all have very high QRR scores. So we hope these stock examples evidence the robustness that we feel is contained within the portfolio to deal with whatever lies ahead. So I'll pass now to Paul to provide some closing remarks on market outlook.
Thank you, David. So this is just recapping a couple of the themes we were talking about. Here's a slide on global rates having peaked. Interestingly, the data here is taken from the 1st of November, and unfortunately this is out of date now, in that the long-term rates, certainly in the US and the UK, have risen quite significantly over the last couple of weeks. And this is something definitely to keep an eye on, and it will have an impact on how the business cycles that we look at unfold. The long-term UK bond rate quietly has gone back to the kind of level it was at following the notorious Liz Truss budget. And clearly this is not a comfortable level for the 5 and 10-year gilt market to be at. And the 5-year swap rate is something that is worth keeping an eye on. That's crucial for mortgage markets. And it's kind of what determines the pricing of the typical UK householder taking out a mortgage, a fixed term mortgage, 2 to 5 years. Those, as have been in the news, those rates have gone up in the last couple of weeks. We'd certainly like to see them coming down. And this is really about the government trying to find ways of restoring some confidence. And if you like, maybe one way to understand the budget that we had was as a gambit in a way that there's, we all talk about the tax rises in the budget, but actually even more significant was that with the spending rises in the budget. And that's really what's driven the bond market yields up. And that will be, that requires growth to come through. And really the gambit here that Rachel Reeves has taken is increased spending. If you do that right, then that should turn into growth. And so that, one of the questions for the next couple of years in the UK is that gambit going to pay off? And it's very important that it does. I think we as UK small company investors are very much at the coalface of that. We experience that growth or otherwise firsthand. And every business manager we know has dug deep in the last couple of years to really underpin their businesses, to make them as robust as possible, make sure they're running with adequate financing and strong balance sheets. They want to be in positions to take advantage of opportunities that come along. And if we start to see that growth coming through in the UK economy, then it becomes a bit of a virtuous circle. Of course, it's too early to tell how the new government's getting on with that. And one of the worries, I suppose, that many of us have over the budget is, to what degree does the government really understand what it takes to drive growth? And that comes back to the point I made earlier about deregulation. It's going to require deregulation and a really concerted effort to deregulate parts of the economy. And this is actually a topic that Rachel Reeves does talk about. So, it's not that there's no awareness of this. And that's really going to be the focus of our attention, I think, over the next couple of years. Just to move on to the next slide here, this is really just an encapsulation of really the extreme anomaly that we've now got between the valuations of the UK market and other international markets. The one on the left is looking at UK equities versus global equities, 12-month forward PE relative. And you can see we haven't seen this kind of level for much longer than I can remember. And since the early 90s was the last time we were kind of at this level of relative valuation. And then on the right-hand side, this is much more of a direct comparison to the US. And of course, it's hard to do like-for-like comparisons. We're going to be careful about just headline market valuation comparisons because, of course, the US has a lot more technology, dominant technology companies, which obviously trade at higher multiples. So this breaks it down sector by sector, tries to make it more like-for-like. And the red dots are really where we were, the post-Great Financial Crisis average. The blue dots are where we are currently. And you can see these are sort of unprecedented lows, really. And that hopefully gives us a lot of elasticity to a more helpful dynamic coming in as soon as we get sort of slightly more benign conditions. And then finally, here we're looking at the relative parts, the relative segments of the market: small cap, FTSE 250, FTSE 100, and you can see, kind of what you'd expect: small cap trades at a discount to large. That's how it normally is. When that sort of inverts, we get worried. That means you're not being paid to take liquidity risk. I think it's very clear now you are paid to take liquidity risk, in so much so that the very bottom end of the stock market, companies below 100 million, the market has become almost dysfunctional. Not entirely, but it's become very difficult to attract new investment to that end of the market, with certain exceptions, and hence the valuations for anyone who is brave enough to go there are pretty extreme. But in the areas we're looking at, it's still a very significant discount for smallness. And then here we're sort of asking this question sort of slightly tentatively. This just shows some previous recovery periods in UK small cap. We've had a bit of a bounce in UK small cap from the October 23 lows. It doesn't really feel like it yet. This feels much more like bumping on the bottom to us. But hopefully with some really good potential here for some meaningful recovery in the period ahead. And I think that's probably covered all of the main themes in terms of summary and outlook. I noticed we've had a question coming in about the UK budget having brought some clarity, and the US election outcome. Has that changed our thesis on UK small cap? I think the answer to that is not really. I mean, in the sense that we've been recognizing we need robust companies. We need companies that can drive their own success without favorable headwinds from government policy or interest rates or economic growth. Insofar as we can do that, there are some pretty major themes out there which are newer themes, and defence is obviously one of those, and our largest holding being Kinetic. I think it's fair to say that the outlook for, sadly, and I don't say this with any great pleasure, the outlook for defence spending over the next decade in Europe, the US, Australia is on a relentlessly upward trend, and it's certainly a theme that we're exploring pretty heavily in fund and in potential holdings in fund too. Just as an aside, it's interesting that a couple of years ago there was a lot of chat about how nobody wanted to invest in defence companies for ESG reasons, and I know that that's a question that we still get asked about. Our basic position on this is and has always been that we don't regard it as ethical to take the decision that you won't invest in defence companies, given that we absolutely need defence companies in order to secure our future. And so there are ethical questions that we ask heavily of any defence company we look at. But the idea that you would simply say somehow it's a good idea not to invest in them, for us just seems completely nuts. So that's never been our policy, and there's an ESG essay on our website which explains a lot more about those things in detail if anyone wants to look at that. I think I touched on the politics of next year and the uncertainties it brings. Those have been these uncertainties have been with us for a while now, really since the war in Ukraine broke out. We're having to live with a much higher degree of uncertainty than we've done for many years. I don't think anything's really changed about that. The Trump election probably raises the stakes in that big things are going to happen. We just don't really know what they are. I think if we're honest about it, the UK view, and this, I don't know if this reflects everybody's view, but the UK view is that Trump is going to bring relatively unstable government to the US, and that's not a good thing. The unpredictability of it, the tendency to make pretty what might seem to us pretty irrational decisions, that's not going to comfort us. Hopefully, in the mix of all of that, some good things happen too. And even thinking about defence, we now have the prospect of do we get some kind of reduction in hostilities next year? If so, is that a good thing? These are big questions, and I guess we'll find out early next year. And with that, I think we'll call it a day. Thank you very much for joining us. Here's some written comments on summary and outlook. We'd love to invite any questions that you have yeah, so please do send those through on the platform. Thanks very much indeed.
Thanks, Paul. We've got one or two questions that have come in, and the first one, given Scott talked a lot about AIM, the first one is it prudent to have half the portfolio in AIM?
Yeah, I mean, just to reiterate what I said earlier, Colin. Yeah, I mean, it's been a part of the fabric of Amati, since the business was launched. It's not a new thing for the fund to have significant exposure to AIM, and I think we see our job as trying to maximise future opportunities, and we've effectively been given a fairly big opportunity in AIM more recently, by virtue of the long period of underperformance that we've seen from AIM, and that's thrown up some fantastic opportunities. I would reiterate the point that we have to be agnostic about this. We are a small cap and AIM fund, and we don't necessarily get too worried about where the company is listed, whether it's on AIM or on the main list. And indeed, there are some companies which will make the move from AIM to the main list. I mean, David made reference, to Alpha Group, which has indeed done that, and has continued to prosper. So companies can and do change. I think the important thing is that we find strong companies that can deliver great returns for the fund. So I think we are unashamedly committed to that, and AIM will continue to be a really big part of that. We can't ignore the fact that AIM's facing challenging times. That is stating the obvious. It's not a growing part of the market at the moment, and we can only hope that something changes with regard to regulation, that Paul referred to earlier. But we're basically as committed as we ever have been to this part of the market.
I think it's important to say, and hopefully the presentation backs that up, that AIM is a very broad church. There's a tendency for investors just to feel that it's a very fledgling, relatively early stage, universally early stage market. Scott's mentioned Alpha, another company that's indicated that it may well move from AIM to the full list is Gamma. These are very significant market cap companies, very robust growth companies. So our job, given the valuations that are out there, is to identify and stock pick those sorts of quality growth stories that we feel are mispriced and can generate very attractive investment returns.
Great, thank you. We have another question on, Paul referred to gilt yields earlier in the presentation. Do you think high gilt yields now partly represent a stronger growth outlook, as is being increasingly attributed to higher US Treasury yields?
Yeah, that is an interesting question. I think really certainly in the UK, and I won't pretend to have any sort of major insights into the US Treasury market, because we don't deal with that directly. But I think in the UK, it's really a function of the budget having significantly increased government spending across the whole of this coming Parliament. And it was pretty significant. So the market reacted a little bit in fright to that. And while the level of taxes that are going to be collected from the tax rises are uncertain, the level of spending from the spending commitments are kind of certain. And I think the gilt market was probably was reacting to that. And we have a pretty flat yield curve now between 5 and 10 years. So I guess there's a certain amount of agnosticism about growth across that period, and there's a lot to prove still, and the government really needs to achieve its top objective of stimulating growth in the UK.
I think as Paul says, we're not US Treasury experts, but there's a degree of influence on US yields that comes from, yes, the expectation that Trump will be good for growth, but he may well generate inflationary growth, and so the bond markets are reacting to that. And I think both in the UK and the US, there is a concern about the degree of issuance that is required down the line, and bonds and treasuries are reacting to that as well.
Good stuff. Thank you.
Yeah, and actually, just on that point, in the US, there is incredulity amongst economists that the US would take this opportunity to cut taxes at this point. Can the US afford to cut taxes? Well, maybe, but I haven't met an economist who believes that yet, and I'm sure there are some, but I've certainly come across a lot of incredulity about it. So that could well explain the rising gilt yields as well.
Thank you. And we have another question here. I'll put to David. Do you see M&A activity continuing, and will that be enough to generate momentum in UK small cap?
Necessary but not sufficient, I think, is a short answer. We do see the activity that we've experienced within the portfolio continuing. It's the valuations of good quality growth companies is just too tempting for other corporates and for private equity to ignore. And that's both a domestic story and an international one. That is going to continue. I mean, rising interest rates is a slight impediment to activity by both those players. But I think the direction of travel is for more activity. But I don't think that is enough in its own right to lead to the sort of re-rating of the UK market back to smaller companies market back to historic levels. For that, we simply need more buyers of UK funds. It's as simple as that. More buyers than sellers, reversing the current situation we find ourselves in. If we get that, then that alongside corporate bid activity will help drive the market upwards. I personally feel that reversing the nature of the fund flows probably does require policy initiative. It's not going to happen of its own self-help accord. It needs a bit of a carrot dangling. And just on that point, and I'm at risk here of kicking the can down the road, I know, but there was an interview in the FT with the UK Pensions Minister, who I suppose is picking up the baton from what the Chancellor said, Rachel Reeves said in her Mansion House speech about getting pension funds to invest more in UK, principally private equity, private assets and infrastructure. That's the priority at the moment. But the interview with the Pensions Minister suggested that if that didn't happen, or it didn't happen enough, then potentially the government would have a second go at encouraging pension fund appetite for UK assets, and sort of hinting that that might involve some support for public markets as well, which is what's lacking here. In a sense, private markets don't need any more stimulus. Public markets are the ones that is the one that needs it.
Great stuff. Well, thank you very much. And on that encouraging note, I shall draw the presentation to an end. And thank you to the presenters, and also for the audience and your questions, your support and your interest in the fund. But if any other questions come to mind, please get in touch with one of the sales team shown on the screen there and also on our website. And just remains for me to say thanks very much for joining us. And until the next time, goodbye for now.